Okay, so global defense demand is surging, but somehow the actual process of building next-generation missiles and space robots is suddenly eating into Northrop Grumman's margins. Welcome to Earnings Unscripted. It's July 21st, 2026, and today we're looking at Northrop Grumman's second quarter. Ticker is NOC. The headline numbers look mostly okay. Revenue was up about 5% year over year, and earnings came in comfortably above the street at $7.68 a share. But the market got super jittery. The stock gapped down hard pre-market, then kind of ground its way back during the session to close down just under 2%. Miro, why the roller coaster?
The tape reaction makes perfect sense when you look under the hood. You read that massive EPS beat and think it's a huge operational win. It isn't. The bottom line was basically padded by an abnormally low tax rate, thanks to a favorable IRS audit resolution.
Oh, so they didn't exactly sell more stealth bombers to get that specific beat.
Right. They basically pulled a future tax benefit forward. The CFO admitted on the call that they're trying to prove core operations are strong despite the tax noise. But the problem is, the operations have their own noise. Space and defense margins took a real hit from estimate at completion charges.
Okay, wait. I saw that exact phrase in the release. What does that actually mean in the real world? Just that a project went over budget?
Basically, it's the defense industry's way of saying, oops, we hit an engineering snag and it'll cost a lot more to finish the job than we originally promised. They had some testing anomalies on a new tactical missile and a space launch booster. So investors saw the shiny tax-driven earnings, then scrolled down to see the core margin headwinds, and understandably panicked right at the open.
Makes sense. And obviously we're just throwing our own takes around here, definitely not handing out personalized investment plans, but you're saying the underlying demand is actually totally fine, it's just a growing pain.
I wouldn't say they can't execute. It's literal rocket science. Anomalies happen. And the total backlog, which just cleared $104 billion for the first time, provides a fantastic floor. But when your backlog is bursting like that, the market expects smooth conversion to profit. Today just proved that rapid scale creates physical friction.
Fair enough. You know, they talked a lot on the call about commercializing space robotics, like literally launching a bot to strap a jetpack onto an aging satellite to extend its life, which sounds completely incredible. But before we get lost in orbit, we really need to figure out what's happening with their cash flow, because I want to know why this B-21 bomber capacity ramp is turning their capital spending into such a heavy multi-year anchor.
Exactly. It's all about the factories. They agreed to expand the B-21 production capacity early this year, so that means laying down heavy, permanent infrastructure before the real volume production starts.
So wait, are you saying they just bleed cash for the next 5 years until they actually hand over the bombers?
No, not quite bleeding, because they actually swung back to positive free cash flow this quarter, mostly just bouncing off their normal seasonal Q1 trough. But the cash flow is, well, it's being structurally compressed. They're forecasting capital expenditures at roughly $1.8 billion for this year, and they'll hold CapEx around 4.5% of total sales all the way through 2028.
That's a massive real estate and hardware bill just to sit in the waiting room.
It's definitely heavy, but they did pull a lever to ease the pain. They sold a B-21 that was originally supposed to be a company-owned test asset straight to the Air Force.
Wait, they just pawned their own test plane?
I mean, accelerated cash collection is how the CFO described it. It pulls several $100 million into this year, but it doesn't actually change the overall long-term program cash. It's strictly a timing shift.
Oh, got it. So it makes today's balance sheet look a bit better, but the total pie is exactly the same size.
Correct. It's just a trick to cover the heavy lifting of building those production lines.
Well, if we're talking about heavy lifting, I need to drag you back to space because I'm completely obsessed with this mission robotic vehicle thing.
Right, the MRV. It's actually a fascinating business model pivot.
Tell me I'm not overhyping this. A spacecraft flies up to an old satellite, uses robotic arms, and just slaps on a new jetpack?
You're not overhyping it at all. That's mechanically what happens. If a client satellite is running out of fuel, the MRV flies over, docks, and physically attaches a life extension pack. Gives it up to 8 extra years in orbit.
That's literally AAA roadside assistance in space.
Yeah, pretty much. But here's why the market should care. Northrop Grumman is fundamentally a defense contractor, right? They build a product, sell it to the government, get paid once. This MRV program shifts them toward a commercial recurring service model. You're selling subscriptions for orbital maintenance.
Oh, wow. So they aren't just selling the satellite anymore. They're monetizing its entire life cycle.
Exactly.
Wait, but how does that vision balance with those massive estimate at completion write-downs you flagged earlier? Like the Space Division had that rocket motor issue, right? The GEM something?
The GEM 63XL, yeah, that's the tension here. The Space Systems Division took a chunky $91 million hit because of an anomaly in a launch earlier this year. They had to redesign the booster.
So you've got this wild future of orbital subscription services running straight into the harsh reality of rockets occasionally blowing up?
Basically. And they're trying to project total confidence. The CEO literally said on the call, despite the negative performance reflected on GEM 63XL and CWA in the quarter, we are confident in our team's ability to complete qualification and successfully deliver these products.
Right, they're confident, but they still have to absorb the redesign costs today.
Yeah, confidence doesn't pay the engineering bills. It goes back to that physical friction. The vision is flawless, but the physics are expensive, which really makes you wonder how reliable their forward margin guidance can be when you're modeling in that kind of unpredictable execution risk.
Well, they kind of answered that directly in the guidance. They stepped down the space segment margin target to roughly the low 10% range for the year. So management basically admitted that those exact rocket redesign costs will keep dragging them down.
Right. Acknowledging the physics problem, essentially. But what's funny is they still turned around and raised their full-year adjusted earnings guidance anyway, calling for somewhere between $28.60 and $29.10 per share.
Yeah, but part of that's literally just that tax rate magic we talked about earlier carrying through the back half, right?
Bingo. The CFO tried to frame it as solid operational momentum, but if you strip away the tax padding, the core execution on legacy programs like the Sentinel missile is where the real stress test happens next quarter.
Okay, Sentinel. That's the land-based nuclear deterrent. I noticed they added over $7.5 billion for that program alone into the backlog this quarter.
Yes, and it just survived a Nunn-McCurdy breach review, which really changes the stakes for the rest of the year.
Wait, so a Nunn-McCurdy breach? Does that just mean they have to start over and rebid the whole contract?
No, not quite that. It means a government program went so wildly over budget that Congress legally has to review it for cancellation. They decided to keep Sentinel, but now Northrop actually has to build it without any further cost explosions.
Which completely explains why they literally blasted a prototype missile silo with catastrophic decibels and an acoustic test recently. They're practically simulating an earthquake to prove this weapon won't shatter inside the tube.
I suppose if you're billing the Pentagon billions, you should make sure the product survives its own ignition. But it highlights the core operational bottleneck. Demand is essentially infinite right now. They even highlighted having up to $10 billion in multi-year missile acceleration agreements across the portfolio.
So the structural theme going forward is basically survival of the fattest backlog. If they can just deliver the hardware without blowing up the factories, they win?
Pretty much. I mean, next quarter, investors won't care about the headline backlog size anymore. They'll watch whether the aeronautics unit can actually hit that newly raised $14 billion sales target and whether defense margins can scrape back to double digits. If the factories hum, the stock works. If they hit another engineering wall, it doesn't.
A high-stakes physics exam disguised as a quarterly earnings report. Sounds about right. Well, I think that covers it for today. Thanks for joining me to geek out on orbital jetpacks and stealth bombers, Miro.
Always a pleasure. Catch you next time.
If you're enjoying these quick dives, tapping the follow button in your app is an easy way to catch the next one. Just as a heads up, the two of us and the script you're hearing are entirely AI generated. And that's how we parsed all of Northrop's dense defense filings and got this into your feed the exact same day they reported. We'd love to hear what ticker you'd like us to tackle next, so drop us a note at earningsunscripted@datamadness.ca.
Thanks for listening.